What's good? What's good? What's good? Everybody, today I got a really good show for y'all. We're going to be teaching my brother about ICT concepts. I was driving one day and I had this idea because I want to keep giving you guys content, and right now I am super busy with work. As y'all can see right now, I'm trucking, but I'm also a full-time student. But I still wanted to find a way to give y'all content. So the idea that I had was to get my brother, because he have all of the like fancy technology and stuff where we can go live. So I wanted to give y'all content, but I also wanted to make it like productive and make it so that we all can learn together, right? So in this video, I am essentially going to be going over some ICT videos with my brother so that I can teach him how to day trade and teach him how to invest as well. And that's essentially what this video is going to be about. So make sure y'all click the like button, subscribe to the channel. I appreciate all of the news people who have been subscribing to the channel, who have been supporting me and interacting on my community tab. Shout out to all of y'all. Let's get straight into the show.
All right, let's get right into the show.
How you feeling, bro?
Man, I'm always busy, always busy. I'm feeling good though. I'm feeling good.
Have you have you ever heard of ICT before?
Nah.
Okay, so you never heard of ICT. So all of this stuff is going to be brand new for you. So I'm super excited to see what you think, and see how you feel about this information. And I'm hoping that you can really get something from it. Um, the playlist we're going to be starting with, for those of you who's watching this, we're going to be starting with the Market Maker Primer course. This is a playlist that I recommend for all beginner traders to start with. If you're learning from ICT, his mentorship is on YouTube completely for free, and in my opinion, it's one of the best mentorships, if not the best mentorship that's out there in the market right now, especially for free. And I feel like I can say that because I have learned from many different people. I've learned from Tim Sykes, I've learned from Swaggy C, I've learned from Mamba. I've been on IML Academy. I have pretty much paid for every mentorship that you could possibly pay for. And this is another reason why I'm so passionate about telling people about ICT, because I don't want nobody else going out there wasting their money on these mentorships and not even knowing how to really trade for real. So let's get straight into this video.
All right. The video is. I'm gonna put the link to the chat if anybody want to go and subscribe to the channel that we're going to be reviewing. Let's go to it now.
Module hopefully will be a little bit more of a sober reminder about how we should be looking at risk and how we can manage risk to survive and have longevity in our trading.
All right, maybe you had this in mind when you first got into the trading. After all, the guy that sat down with you before told you, hey, this method's so good, you risk 10% of your equity. It's going to make you money. Okay, if you have equity balance of $10,000, you're going to risk 10%. Now, the first loss you assume, guess what you just took? A $1,000 loss. Okay, system says continue risking 10%. So what do? You get in and you take the next trade. Bang, you hit with a $900 loss. Your equity now sits at $8,100. 3 losses. You hit with another $810 loss. Bang. Your account's now at $7,290. This goes on for what could easily be seen in anyone's trading 8-string loss. 8-string loss. That is absolutely realistic, guys. I don't care how good a trader you are. You're going to get this upside your head one day, and you need to be prepared for it. If you're going to risk 10% of your equity simply because you think you're going to be hitting it on the next trade and you've been in drawdown, there's a psychological impact that traders go through. And we more or less deny the technicals that may be indicating that we're in a trade that's not going to pan out. But we won't let go of it. we start arm wrestling with the market because, hey, we're going to be right, and it's going to feel so good when we are, and we can give the middle finger, not to be crude, to the screen, cuss at the screen, say, I got you, I got my money back. Everybody wants to have that, that feeling of conquering the market and beating the guy that took the money from you last time. Everybody wants to go into the end zone, slam the football down, and do their victory dance and all that. But that doesn't work in this business. And they'll hand you your head on a platter. If you give them the opportunity to take your money, and a lot of it, they're going to be more than happy to take it from you. If you just take an 8-loss streak here in your equity of $10,000, your account draws down $5,217. That's 52%. 52%, folks. Do you think you can take 8 trades in a single week? The way some of you guys on these forums trade, this could happen in a day. Now, I'm not saying that most of you guys aren't risking 10%, but there are.
You want to comment on this so far?
Yeah, I do have a comment, and I want the people who's watching leave a comment down below if you can relate to anything he just said. I know personally right now I'm going on my like almost 6 years of trading, and risk management is still something that I struggle with still to this day because like I can have 2 or 3 weeks where I'm just consistent following all of the rules, and then I turn into this guy that just want to like I just want a really big win, and then I take a really big loss, and all my psychology goes down the drain. So I I just wanted to ask people to leave a comment down below if y'all can relate to that as well. Do you have any comments, bro?
I mean, I'm learning. I definitely agree with him that some of the traders can make that many trades in one day because it's easy to make 10 trades if you got the money.
Oh
To
yeah,
be honest,
easy.
if you're not afraid of putting the money up, you might win, you might lose. That's just the way the game goes. So, and
Exactly.
everybody trade at their own rate.
What do you know about risk management so far, bro?
I mean, that applies to every business.
Okay. What do you think will be a good percentage for a trader to risk, even if he was like very skilled?
I think that depends on his life circumstances, what he got to put up, et cetera, et cetera. Because if you can afford the risk, then it's not really a risk.
But give me a percentage though.
20%.
You think a trader should risk 20% per trade?
Oh no, I thought you meant like overall.
No.
Yeah, I don't have it. I don't know.
Just throw a number out there. It's not a right or wrong answer, bro.
Yeah, I'm gonna stick with 20% then.
Per trade.
Yeah.
Okay. So this is, as y'all can see, my brother. He's brand new at all of this stuff. So we're going to continue to teach him. And like I said, y'all leave some comments down below, so y'all can give him some of y'all experiences as well. So let's get back into the video.
All right, let's get to it.
Neophytes to come into this business and think they're going to be able to do it. And I'm sorry, but maybe you'll come off the gate, make a couple wins, and think, man, I'm risking 10%, and look, it's really working out well. But man, I'm telling you, that cycle leads to destruction. All right, just 8 trades. Look at this. If you have 8 losses, you're crushed. That's a huge drawdown. Not to mention the emotional impact and your mental equity, because not only are we trading with real tangible money, currency in our account, that equity base is not limited just to the dollar terms. You have an equity amount of money in your mind, what you're really willing to absorb and risk. You may have put $10,000 on an account, but man, you don't really want to be losing 4,000 of it. So what are you really trading with? $4,000. That's your mental capital. So we're going to talk more about that when we get into wealth building, money management. But for now, understand that risking 10% absolutely should be no-brainer for you. You don't do that. Okay, maybe you're so turned off by 10%, but hey, you're not too afraid of taking risks. So 5% per trade is, it's doable for you. $10,000 starting account. Okay, first loss, bang, $500 loss. Now your account drops down to $9,500. You do this for a couple series of losses. At the fifth loss, okay, now your account's down to $7,737. But hey, you're going to make it back, and you're not going to bend 5% risk on every trade. Well, with the standard typical 8-string loss that can happen to anybody. I'm not saying you're going to have this once a month. I'm not saying you're going to have it 3 times a year, but it's going to happen eventually. If you are in this business at any length of time, you will suffer a 8-loss string. It's going to happen. If you had the risk of 5% per trade, starting with an equity balance of $10,000, your equity would draw down to the tune of 3.
All right, so break it down for us.
No, I was just saying, without a doubt, you're going to eventually go on a losing streak, especially when you're risking like big. Like for me, I don't think I've ever risked 10% on a trade ever, even as a beginner. Well, I remember when I was first starting out, I didn't even really have like a set percentage that I was risking per trade. Um, I was just trading because like I was starting out with my own capital. Like when I first started trading, I was trading penny stocks, so I would put like $3,000 into an account and risk like 200 or 300, sometimes 500 or 600 other times. Not really even thinking of the percentage. And the times that I won, it felt so good, right? If you make 500 on a $3,000 account, you feel amazing. But on the flip end of that, when you lose 500 on a $3,000 account, it's devastating, bro. And especially when you don't know what you're doing. Like, the reason why I give ICT so much credit is because he's the only guy that I have ever learned from where I started having results. Right, I started having like more consistent wins. So that's why I give ICT his credit. But even with all of the information that I have gained from ICT, you still can go on a 8 loss losing streak, right? And I mean, just leave a comment down below for the people who's watching. Do y'all agree with that? Like, have y'all went on 8 losses, 10 loss win losing streak? It can happen to anybody, no matter how good you is. I just wanted to throw that in there. I
I
completely
think
agree
a
with
lot
him
of
on that.
people in business definitely have took losses. Every business take losses. Only a liar would say that they haven't.
Exactly.
And sometimes niggas take more than 8 losses. But let's keep going.
$3,016 or 30% drawdown. Can you withstand that? Can you imagine taking 8 trades in a single week and being drawn down 30%? Let me tell you something. I have done that. Okay, and it is absolutely demoralizing because if you come out the gate strong, thinking, "Yeah, man, I'm gonna tear it up." Well, yeah, you're gonna tear it up, all right. You're gonna tear up your account, okay, and you're gonna sit there and you're gonna be depressed for the entire weekend. You're going to mow over possibly adding more money when that's not the answer. The answer is controlling the amount of money that you put up. And controlling yourself is very difficult when you're in a period of drawdown if you're a new trader. I'm talking from experience, okay? When I got involved with commodities, I was trading, 5 and 6, 7 contracts of Chicago Board Trade wheat. And really my balance really should have been working with one mid-am contract. And I'm not going to go into contracts and specifications for commodities, but I'm just saying that I was over leveraging. And the worst part of it, I knew I was over leveraging. And when I was losing, it didn't hurt enough. I was going to be right. I was imposing my will in the market. And I'm telling you, you will lose doing that. It will hurt you doing that. You don't gain anything from that except for misery and depression. Trust me, I know. Okay? So 5% risk is absolutely too much. It's insane. Don't do it. All right, now let's look at the typical trader's thought going in. This is the standard mentality of all traders. If you read it on all the forums, all the books, we all say it, and I preach it too. Don't risk any more than 2% per trade. All right. Okay, we're going to look at trader 1 up here at the top. Okay, you have one trader starting with an equity balance of $10,000, and he's going to risk 2% per trade. And he runs into the inevitable 8-string loss. It's going to happen. Well, the account draws down after 8 losses, $1,318. Total percentage drawdown, 13%. You could probably withstand that. I mean, most traders could absorb that. Certainly new traders, because they're they're invincible, and they're eventually going to be in the next streak where they make 100% accuracy. So this is absolutely, within the realm of comfort for most people. If they have a $10,000 equity balance and they only draw down, $1,300, most people can absorb that. But let's flip the script for a moment. Look at trader 2. Okay, he starts with $10,000 too, and he's starting with 2% risk. Watch what happens. His first loss at 2% is $200. Suddenly, he has a problem. He has absorbed a loss. Something's going to take place in this trader's mind that didn't take place in the first trader's mind. So his next trade, he only loses $98, but it's still a loss. So the next trade he takes is what? A loss of $48. Look at just after 3 losses, the difference in terms of equity. Where are we at? Essentially in the same neighborhood. But look what happens over the period of the 8 losses. Trader 2, after 8-string loss, his account draws down $538. Total percentage drawdown, 5%. Do you see a difference there? What do you think trader
What do you
2
think about that,
did
bro?
differently that trader 1 didn't do? Number 1,
I think it's valuable information for those who don't have it already, because he definitely teaching you how to save and assess risk in a way that you don't really learn just by just going out and just starting a TD Ameritrade account or something like that. You know what I'm saying?
Exactly. Yeah, I think this is valuable information, but obviously this is something that all traders are going to struggle with. Even me myself, this is like the one thing that I still struggle with. That ICT teaches, and essentially what he's talking about is this, bro. He's essentially saying if you're risking 2%, you take a loss. On your next trade, you cut that in half, you risk 1%. If you lose on that trade, your next trade, you cut that in half again, you risk a half of a percent. And it's when you look at the mathematics, which is what he's breaking down right now, it makes all the sense in the world. But the problem is when traders are trading live in the markets, right? We have a lot of emotions, and then like let's say for example, we take that 2% loss. The only thing that we're thinking about is getting it right back, right? I mean, let's just be honest. For the people who watching, y'all tell me what y'all. Am I lying? Tell me what y'all think. Tell me about y'all experiences, right? Because I need my brother to also hear from other traders as well, so that he can understand. Like, this is a real problem that a lot of traders deal with. Like I said, I'm going into year number 6 of trading, and this is something that I still struggle with. Um, for me, like prop firms really help me with this. As much as I hate prop firms really help me with my risk management because I had no other choice but to risk a half of a percent or 1% because they only give you a certain amount of percent that you can have to lose before you lose the entire account. So with prop firms, for example, bro, I know you probably don't even know what prop firms are, but let's say prop firms tell you can only lose 5% in one day. If you start your first trade off with a 2% loss, it's over, right? Because let's say you try to get that 2% back, and then you risk another 2%, and let's say you lose on that 2%. Now you're completely done for the day, and you're down 4% in one day. So this is definitely something that I'm still like working to get better at myself, and I'm curious to know like who's watching right now. Are y'all struggling with this same thing? That's all I wanted to say, bro.
Okay, yeah, it's a good video so far. Let's get back to it. Shout out to ITC. Let me make sure I go
Yeah.
get that link real quick so I can drop it in the chat real quick. In case anybody want to go subscribe to his channel. All right, let's get it.
He identified the fact that he is not perfect. He identified, or she rather, in deference to the ladies that are watching this, sorry gals. The second trader here, our case study, when he absorbs a loss, okay, it only takes one to do this. The first loss, immediately he cuts his risk in half. So no longer is he risking 2%. So now he has to draw down of $200. So he risks, on the next trade, when his account equity is at $9,800, he's going to risk 1% per trade. Now, he assumes another loss. Does he stay at 1%? Absolutely not. What does he do? He drops down to 1/2 of 1%. So his next trade, he has a loss, $48.51. Guys, you can take that. If you got $9,700 in your account and you can lose $48, you can lose $50. You're not losing sleep over that. If you lose sleep over that type of loss with the equity balance of $9,700, stop trading. It's not for you. Go bet at the horse races, play lottery, something like that. But I'm telling you, you have to assume some kind of risk. This goes along with everything that's been discussed at the beginning of the disclaimers. I mean, you have to understand you're going to lose money in this business. And if you're not comfortable with losing money on a consistent basis where you're not perfect, bottom line is stop trading. Okay, I have losses. You're going to have losses too. I can't teach you how to trade perfectly without losses. No one can. You're not going to be able to find it. And if that's the grail you're looking for, it doesn't exist. Trust me, it doesn't exist, because I'd pay everything I have for it and it's not there. Trust me. So let's keep this train rolling here. Okay, after he drops his equity risk to 1/2 of 1%, okay, and he has another loss, the fourth loss, okay, $48.27. Well, he takes another loss. He stays at 1/2 of 1%. Look what happens at the end of his 8 losses. He's got a huge amount of his starting equity still at his disposal, and he suffered 8 losses. He hasn't had one winning trade yet. Now, contrast that with Trader 1. This guy, he's down $1,300. Trader 2, he's only down $538. The 5% drawdown is absolutely tolerable in any one trading. I mean, you're gonna suffer 5%. Good grief, 5%. That's what you're trying to make in a day. Some of you guys that are trading, you have to control your risk. Okay, if you have a loss, cut your risk. If you have another loss, cut your risk. Trade and drop down to 1/2 of 1%. Now, if you have 5 or 6 trades, then you've lost that 1/2 of 1%. Drop it down to 1/4%. Okay, whatever suits your risk appetite, that's what you have to do. But you have to go the other way. You do not average down. In other words, you don't take, well, I lost 2%, let me risk 4 now, because if all it takes is one trade and I'll make that back and maybe even make the 2% I was hoping to make.
So, Trucking, got a question. How much money would the average user need to, open up one of these accounts and start to see profit?
Start to see profit, that's a whole different story, but I would say a good amount to start with is like $1,000 for a beginner. Because like as I just told you, bro, when I first started trading, I was putting 3 or 4,000 in a account, not even knowing what the hell I was doing, and I was losing it. I was losing all of my money. I'm gonna be honest with you, I was losing, bro. I remember this one. I
That was
remember,
years ago.
yeah, that was years ago, bro. But I remember, I remember when I first started learning forex, bro. I had put like I think I had like 3,000 in the account, right? And this was before I even knew like about lot size or risk management. And I had took a trade that they called out on IOML Academy, and I was up like 2,300, bro. And I did not lock it in for some reason. I was just greedy. I didn't even know, like it was just so fast. Like I was up like that, 2,300. Didn't lock it in, right? I was all bragging. I was showing my girlfriend everything. I was like, hey, look at this. Yeah, you got to get into trading. And then, bro, I kid you not, I had took like a $2,300 loss. I pretty much blew that whole account in one day, bro. So I always recommend like new traders start small, man. Like start with like $700 to $1,000. Start off small, so and do what ICT is telling you to do, because if you start with $1,000 and you're only risking 1%, that's only 10. You're only risking $10 per trade, right? So you can lose $10 on a $1,000 account without becoming overly emotional. But if you risk like 10%, which is $100, and let's say you go on that, you keep losing, you're going to definitely become emotional. So I would
Do
say
you think
seven
we can
hundred
take
to
the
a
same
thousand.
formula and apply it to like sports betting and other stuff?
No, 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 no. I don't do sports betting only because I feel like that shit like don't get me wrong. I do feel like trading is a scam. I don't feel like it. I tell people all the time when they ask me. They ask me all the time. They say, "Hey man, is trading a scam?" I tell them all the time, "Yes, it's a scam. The markets are rigged. There's somebody pushing a button. There's an algorithm. There's somebody who's controlling everything." But what I don't like about sports betting is that you really can't control. I mean, to some degree, you can control your risk, but you really can't control it the way that you can control it with trading. I'll give you an example, right? As a trader, if I'm risking 1% and the trade starts to do stuff that I don't like, I can cut my trade at a half of a percent, right? So if I'm risking $100 and the trade start to do stuff that I don't like, and I'm negative $50, I can just get out of that trade and be done. But with like sports betting, you put that 200 up and it's either win or lose. There is no middle ground with sports betting. So that's why I don't like sports betting. I love poker, but I even stopped playing poker, bro, because all of that stuff, like you're going to lose a lot of money with that stuff. And at least with trading, once you get this skill, you have it forever. Like once you lock it down, you can capitalize on it forever. Sports betting is mostly luck. It's not even really a skill. Some people may argue that. I don't really know. Maybe that's not a true statement, but I don't think it's the same at all, bro.
Okay. Let's get back to it. And shout out to everybody. Make sure you hit the like button, comment, subscribe to the channel, and make sure you share the video out. Let's go.
On the previous trade that lost, or I only have to make half of what I lost in terms of pips on the last trade if I risk 4%. Don't do that, guys. I've done it. I'm telling you, I've done it. Granted, I'll go give you this, and I'm going to be fair. There's been times where early on I did it and it worked out in my favor, but when I tried it later on, it crushed me and it never gave it back to me. It took more and it took more and it took more. And I'm telling you, it is a loser's game. Trust me. I know this by firsthand experience. It never pans out over time. Doesn't happen. Okay. So just don't do it. If you have a loss, cut your risk. Cut your risk. Cut your risk. All right. Now let's stretch this out a little bit. All right. Trader 1 had a drawdown of $1,300, okay, on 8 losses. Not one trade was a winner. All 8 were losers. Well, look at Trader 2. Let's assume for a moment the guy hits into, he's got a bad run. He's got some problems in his personal life. The 9 to 5 is getting him, stressed out. His boss is driving him crazy. He's rushing trades. He's not following the system. He's not feeling well. He's spending too much time in the forums and not really studying the charts. It's something that's keeping him from being disciplined. Okay, he's not hitting on all cylinders. Something's wrong. Maybe he's got a system that doesn't work. Maybe he hasn't abandoned his bad habits. Bottom line is he's not made a profitable trade yet. Look what Trader 2 can absorb. He can absorb 3 times the amount of loss that Trader 1 can, following the same approach. The first loss, risking 2%, he only draws down to $9,800. Second loss, risking 1% now because he's trimmed back to his risk, he only loses $98. His drawdown goes to $9,700 in his account. Now he's at 0.5%, and he stays there, okay, all the way through up to 24 losses. This gentleman or young lady could have a loss string of 24 losses and still be less than the first trader. Think about that. This guy or gal can have 24 losing trades and still have lost less than the first trader on 8 trades because he didn't
Isn't that crazy, bro?
his risk exposure. You have to control.
No, yeah, that is a crazy stat.
Crazy stat. And I feel like the reason why most traders lose, even experienced traders, is because they don't follow these simple rules that's going to save you. Like especially because like the internet is so popular, everybody see people like Mamba making 80,000 on one trade. But obviously, if you're trading with like like Mamba trade with like $1 million account, you know what I'm saying? So his risk parameters is a lot different. But when you're starting out and you only have like $1,000 account or $5,000 account, you have to be really, really, really disciplined, especially when you don't know what you're doing. I I tell people all the time, if you don't know what you're doing, just don't even put real money up, because like that's one thing that I regret as a beginner trader. Like I just told y'all, when I first started, I was instantly the moment I heard of forex, the next day I'm putting 5,000 into an account. So I always try to tell people to advise people using my own experience as well. But that's all I wanted to say, bro. I thought that was pretty interesting. Like imagine losing 24 trades in a row and still losing less money than the person who lost 8 trades. That's crazy.
That's just good risk management, good calculation, and learning how to not be a greedy motherfucker.
Exactly.
If we keeping it 100, because that's what those people do when they let me go all in so I can hit the lottery real quick. It don't work that way, bro.
Exactly.
All right, let me see. Where the video? Let's go.
Control the amount of risk in your account. If you do not do this, no one's doing it for you. I can't do it for you. Your wife can't do it for you. Your husband can't do it for you. Your kids can't do it. A broker certainly ain't going to do it. Okay, so you have to have this in your plan. It has to be mounted on the wall, tattooed on your hand. It's got to be on your forehead. So when you see yourself in the mirror, you see this all the time. Control risk. I can't stress it enough. Nobody talks about it enough. And you have to do this. You absolutely have to do this. Okay, this will give you the Viagra effect. Not to be crude, but it gives you the staying power. You have to be able to absorb losses. Because I'm telling you, these banks, they're ruthless. As good as my methods are, I still get slapped around sometimes. Okay, it's going to happen. Now, granted, when we drop down to 0.5%, okay, we're not probably going to make a whole lot of money coming back out of it. Sure, that's fine. But there's a strategy that we're implying that goes a long way in terms of a profitable career. Okay, if you can absorb 24 losses and only have 12% drawdown, you're controlling risk. There's not a trader out there, okay, that can beat their chest and say, I've been trading for 5, 8, 10 years, okay, and I've never had an 8-string loss. Okay, I'm telling you, they don't. That's a unicorn. They don't exist. Okay, so you're going to have strings of losses. I'm showing you how. Even with, and I've never had 24 losses. I'll give you that. I've never had a string of 24 losses, but I've given you a shield. Okay. I've given you a mindset. When you step out of that arena and risk your capital and you risk your money, this is your only defense. This right here. Okay. It's not the trade signals. Okay. It's not the amount of money you put in the account to start with. It's the amount of money you put up. Because whatever you offer them in your hand, open palmed, they're going to take it if they can. So if you give them a large percentage of it, all you're doing is enticing more interest in taking it from you. Okay. So the moral of the story is, if you have a loss, cut your risk. If you have a loss again, you cut your risk and you drop down to 0.5%. Okay. And you stay there until we have a turn in equity. And when you start making money again, start being profitable, okay, there's a way of going back to the original risk exposure. Say your maximum risk exposure is 2% per trade. Okay, how do we compensate for that? How do we get back to that point? Well, let's talk about that now. How do we go forward with this information? Okay, well, when we experience a loss, the first thing you want to do is, number one, reduce risk. That's the absolute first thing you think in your mind. Not, let me get back in and try to get my money back. No, you cut risk. Why? Because you already have a state of mind where you feel you're victimized. Okay, I don't care how long you've been trading, losses still have an impact. Okay, I don't like losing. I hate losing. Okay, because my method wins more than it loses. When it happens, I don't like it. Okay, but I don't beat myself up about it and go in and say,
Your audio went your video went dark, trucking. Let you know.
Yeah, can you hear me?
Yeah, I hear y'all. Just letting your audio in case you want to just have like your avatar up. And turn your camera off.
All right.
All right. Oh damn. Yours because you up as mine. I'm a edit I'm gonna edit StreamYard so I can add you an avatar in, your avatar in. That way it don't be my face up there. But it's all good. Let's go.
Yeah, it's
Well,
all
I
good.
lost $500. I'm going to get in there and trade, and I'm going to try to make $2,000 on the next trade because I lost five. I want to get 4 times as much money back, and I want to do it in half the time. I don't think like that anymore. I did. I'm going to give you this. I did think like that years ago, but I don't need to do that anymore. Okay, and you don't need to do that now. If you haven't adopted that bad habit, this is hopefully keep you from doing it. So, if you take a loss at 2%, the next trade you will only assume 1% risk. Now, should this trade result in a loss, the next trade will only assume 1/2 of 1%. Okay. You will only risk 1/2 of 1% per trade until you have made at least 50% of the drawdown of the equity dip from the trade risking 1% of equity. Okay. So in other words, the trade that you lost when you were risking 1%, whatever that amount is, let's say it's $500. You need to make $250 risking 1/2 of 1% before you can trade up to the 1% risk per trade tier. Okay. Now you're going to risk 1% per trade until you make at least 50% of the equity dip that you used when you risked 2% per trade. Okay. So again, if you're risking $500 when you were risking 2%, at 1% risk, you need to make at least $250 before you go back to risking 2%. If you lose, you go back to that system again. You drop, cut it in half, cut it in half, cut it in half. And now you have an opportunity to step back and say, okay, I can take some blows, I can get knocked around, but I'm not getting taken out of the game. Okay, so now hopefully, with this presentation, you can breathe. There's a way of doing it, guys. Okay, and this is how it's done. You can't stay in this business without controlling your risk. That's the moral. Stick to the game plan, stick to the method of controlling risk using this approach, and I absolutely guarantee, okay, you want the Holy Grail? This is the Holy Grail. This is it. You have to have a shield in this business. If you don't, your money's going to come to me. It's going to go to the central banks. It's going to go to the guys that know how to do this, okay? Because I'm going to be in the game years from now, and I'm going to still apply this approach. When I have losses, this is how I do it. This is what kept me in the game as long as it has been. It's going to be a concept that I hold closest to me because this is more important than my entry signals. This is more important than my exits. This is the absolute key and cornerstone to long-term success and careers in trading.
I'm about to say shout out to
So
ICT.
let's do some active recall.
I just about to say shout out to Mel for being in the chat. She said tuning in from home. Thanks for teaching us. Shout out to Trucking. Go ahead, Trucking. Go ahead.
I was gonna say let's do some active recall, bro. What did you get from that video?
A few different lessons about how to risk and how to assess risk. Like when I said 10%, clearly I know now that was way too high.
Yeah, you said 20%. You was about to
Oh,
blow
yeah,
your account up on the first 3 trades.
Fuck it, I'm blowing it all. But no, that was one thing I learned from that.
Let me ask you another question. How hard do you think it will be for a new trader to follow that concept that he just laid out?
With discipline, not hard, but if they don't get no discipline, then it's over.
Okay. All right. Let's get into this another video, guys. We about to go into the second video in ICT's Market Maker Primer course. Like I said, this is the course that I recommend all new beginner traders to start out with on ICT's playlist because as you guys know, he have a lot of stuff in his playlist and it's easy to get lost in that playlist sometimes. But this is the one that I recommend for all beginner traders to start out with. So let's get into that second video.
All right, let me go get it. Let's get it. me 1 second while I pull it up. And just for the record, for those again, the second video is on ICT channel. ITC channel. Make sure you guys go subscribe to his channel. Again, I will be dropping the links in the chat. The second video is titled ICT Forex, what new traders should focus on, which was kind of what we were just talking about. Give me 1 second while I load up. All right, let's get it.
You got some old school sound effects on there.
Hello, folks. Welcome back. All right, so we're embarking on a new journey for some of you, and for those that have gone through my old vintage ICT tutorials, these will probably be a little bit more user-friendly and concise. I did have the aim and goal in mind to make them as short, concise, as dense as possible with content, but still not be so long in the time window. I want the durations to be a little bit more manageable. So that was the goal for this this round of tutorials. We're going to be talking about what should new traders study and practice. Okay, so what's going to be covered in this module? Okay, the ICT concepts used in this one is going to be the theory of liquidity raids or stop runs, introduction to liquidity pools, how to locate high probability liquidity pools, introduction of the ICT order block, high accuracy entry points, low drawdown entry tactics, high probability targeting, the benefits of scaling profits, and how to make money when you are wrong. All these concepts and ideas are going to be used in practical application, but before we show you that, it's important that I begin with an overview. Okay, so when we look at price action, as a new trader, you're going to come into the marketplace, especially with forex, because it's so exciting, it's fast-paced, it's a wonderful market, it's a beautiful market. It gives plenty of opportunities. You can be day trading it, you can scalp it, you can position trade it, you can swing trade it. It's absolutely phenomenal. I love it. To me, it's the best asset class today. However, like you, when I first got engaged in the study of price action for forex, I quickly found myself doing a lot of things I shouldn't have been doing. And what's worse is I was an experienced trader from other asset classes, stocks, bonds, commodities. And I did trade the currency markets by way of the futures market. So you would think, having a decade of, or more really, of experience before getting involved in the foreign exchange market, that I would have had a little bit better grasp on my emotions and my excitement. But that didn't happen because it's a 24-hour market. It moved around very liquid, and it was like a candy store for me. So I did a lot of things wrong, and I've learned over the years. And these videos are going to help you avoid a lot of those pitfalls. So we're going to cover an element of price action that I think is essential. And if you have no previous trading experience, if you've not corrupted your mind with the retail stuff that is promoted in the industry, you're actually at an advantage. Okay, folks that have gone through trading courses and material are going to have some hardships with this, not just with this teaching, but all of the ones I'm going to be teaching. The constant theme is I want you to think about the marketplace completely opposite to what retail teaches. So retail is like Elliott wave, supply and demand, harmonic patterns, animal patterns, all these things that you put on your charts. They're all distractions. All you need to know is the open, high, low, and close. Okay, there's 4 reference points that make up price, and we make charts based on those 4 reference points. Now we have an element of time that's a factor that won't be talked about in this module, but I will talk about it in coming lessons. But I want you to think about when, for instance, we're looking at this chart here. Now this happens to be the day of this recording's euro dollar. Okay, it's a 15-minute time frame, and I want you to look at it, and maybe some things jump off, maybe other things aren't so apparent or obvious to you, but I want to kind of like change your perspective on price action. And I want you to focus in on areas in price action. It doesn't make a difference what time frame you look at, okay, because price is fractal, meaning that the things that you can see on one time frame, they can be seen on the lower time frame or the higher time frame as well. So it's a phenomenon that it repeats itself. Okay, the same type of formation or setup can be seen on every time frame. So when we look at price, or how I teach my students to look at price, I want them to first understand what makes the markets move. Okay, without understanding that, your probabilities of being successful in developing yourself in a demo trade is highly unlikely. And you must well forget about becoming a live fund trader. If you can't do well in a demo, you're not going to do well on a live account. Everything that I'm teaching here should be done in the medium of a demo. All of my teaching is done in a demo, and that's just the best way to do it. Play in the sandbox, it's risk-free, and you learn to develop good habits this way. So what do you do with a demo account? Well, before you even put on trades, I think that you should be studying price action like this. Okay, I want you to think where everyone else's trade idea would fail them. Now think about that, because when you read books, they tell you buy here, sell here, your stops here, try to aim for this target. Okay, so they're geared towards getting you into a move, and the stop losses are pretty generic: below an old low, above an old high. I have started a new wave of free membership followers online, and they have shared their enthusiasm with the discovery of something so simple, but it evades most traders, even traders that have been trading for a long period of time. If you look at periods in price action where there are equal highs and equal lows, this is the easiest, most obvious price point to see in charts. Every time you see that, I want you to note that. Okay, put a small little trend line horizontal. Okay, and that's the only type of trend line I like. We're delineating previous points where it made equal highs or slightly higher or lower. It doesn't make a difference if it's exactly or if it's off by 1 or 2 pips. The general theme is if it looks close enough, then it's a double top or a double bottom. Now, retail circles will teach that these are good areas to trade off of as support and resistance.
All right, break that down in layman for the audience who may not understand exactly what he's saying.
So essentially, right now, what he's talking about when he mentioned a double top and a double bottom. Okay, think about support and resistance on this chart, right? You see those boxes that he highlighted?
Yeah, I
Hello?
see him. I see him. Yeah, I'm here.
So those boxes that he highlighted, those are what a lot of people may call swing lows or swing highs, right? It's essentially a swing low and a swing high is essentially a 3-candle pattern where the candle in the middle is higher, right? The wick of the candle is higher than the candle to the left and the right of it. So if it's a swing high, it's going to be right. The candle in the middle is going to be higher than the candle to the left and to the right, and the same for swing low. So essentially, what he's talking about when he mentioned double bottom, right? When the market makes these like swing lows or swing highs, sometimes you will see like the market may come down to a level and stop right there again, and then it will create like a double bottom. Is essentially what it's called. So think of it as like support and resistance levels. Do you know anything about support and resistance?
Not exactly. That's why I'm listening to you.
So just think of support as like the ground that you walk on, right? It supports you. And resistance, think about resistance as like you trying to break through something. So think about it as like a ceiling, right? So the boxes that's at the top of his screen, those are typically like resistance levels, and the boxes that he highlighted at the bottom will be like support levels, in a sense, right? So that's the best way that I can explain it to you right now without giving you like a long 20-minute answer. Um, but it's also something that you're going to have to dig into yourself to kind of like learn about it more, like even outside of the video as well. But it's essentially where, like, if you're looking at that chart, bro, it, do you see the like? Okay, look at that yellow box to the far right of the screen, right?
Yeah, far right of screen.
So, so do you? Okay, this ambulance about to pass me. It's probably gonna mess up my audio. So, do you see how those little wicks, right? Those little lines are like real close to each other.
Yeah.
That's a double bottom. Are you keeping? You're not just saying yeah just because you want to continue on, right? You actually understand what I'm talking about, right?
Well, yeah, I'm looking at what you're talking about.
So that's essentially what a double bottom will look like, and then vice versa will be a double top, right? When you see those lines and they're stopping like right near each other, that's what a double top will look like. So essentially, all he's saying is when you're going into the market, you want to be able to identify these levels.
This is what you would call a trend, right?
Um, no, this is not what you would call a trend. No,
Okay, see, that's what I had to ask.
a trend, a uptrend is when the market is making higher highs and higher lows, right? So think about that classic zigzag pattern, right? When you do a zigzag pattern, I mean, just think about any market, bro. I mean, I'm pretty sure you have at least seen at least one chart in your entire life, so you know what the uptrend is looking like, right? Just think about a diagonal line going up, right? But obviously, the market just doesn't go in one diagonal line, right? The market has to go up and down, back and forth as it goes in that
Look
diagonal line, right? And
on the
then
graph, that part that's highlighted in the yellow is going down, and then right afterward, it skyrocket up. Is that not a trend up?
yes, yes, that's a trend up. That's correct. From
But
from that from that
that's
yeah
not the
from that
double up thing
last.
you're talking about.
No, yeah, that's not what he's talking about. But that is what a trend is. Like if you look at the last two boxes, right? You see the second yellow box from the last box,
Yeah,
and then you see that last yellow box. That from that top box to that bottom yellow box, that's a downtrend.
right.
So
But
that's what a
everything
trend is. But
light.
yeah, so that's what a trend is. But that is not what he's talking about right now. But that is what a trend is.
Okay, okay. All right. Thanks for clarifying. Mel in the chat says the yellow part is highlighted. Yes, yeah. That's what we're talking about, Mel. All right, let's get back to the video.
Since institutional minded traders think entirely different. They know what's sitting above those equal highs. It's traders' buy stops. And they know what's residing below the equal lows. Traders' sell stops. So the way institutional mindset is poised about looking at price action, they're looking for counterparties. They're looking for the opposite side of their trade. So when everyone else is in the retail world looking for indicators to give them buy and sell points, institutions are actually thinking, where are the orders resting right now? And the easiest way I have learned to teach traders to start with, and there's other ways to do this, but as far as I'm going to go in the free content, this is the only one I'm going to teach. And it's a very simple one, and literally a 5-year-old can see it in the chart. So anytime you see a double bottom or a double top, put a small little segment or a line above it or below it, delineating it, and put a notation what it is. Above double tops on your chart, make a small little notation that it's buy stops, and below equal lows, sell stops. And I want you to study. Do not demo trade. Do not try to pick the direction. I want you to study it for 1 full month. Do nothing else. Pick 1 or 2 pairs, literally go through and watch how many times this phenomenon takes place. You can look at it on any time frame, but I think a 15-minute time frame is ideal because you'll see a lot of scenarios pan out. Now, I traded 2 markets today at the time of this recording. I sold short the dollar CAD, and I also sold short the euro dollar. Okay, both pairs generally do not move in the same direction, but I knew there was a strong likelihood that the dollar CAD would sell off aggressively, and therefore any movement down in the euro dollar would be a suspect decline, and it would be reaching for sell stops. So that's going to be the context behind what you see me do later on in this video that was a recorded trade. So as we're looking at price, I want you to take a look at this area right in here. Okay, we have equal lows, and price has already went above an old high and broke down, and it's found an area of consolidation. And this is the very consolidation that I taught you how to trade the New York setup for scalping. I want you to think about that. If this is a short, where could you reasonably expect to see price go? Well, obviously, we would expect it to go lower, but targeting what specifically? Well, we know there's equal lows here, and I like to look at old lows and old highs and project 10 to 20 pips beyond those double bottoms and double tops. So in this double bottom, folks see that as support. Price comes down, hits it here. Retail-minded traders are going to see this rally up as a buy. I do not want you to think that. I want you to think the opposite. I want you to think that this whole scenario is just the market getting ready to sink and go lower and attack the sell stops that are below the marketplace here for those traders that have been fortunate enough to be long in all this movement, rode up to this high, but still did not take profits and have open positions, and their protective sell stops are going to be trailed up below these lows. So institutional-minded traders, they're going to see this as liquidity. The market will drop down 10 to 20 pips below equal lows, and that in itself, you need to be determining whether or not that's a trade that's viable for you. So what's a viable trade? I
So
teach
pause it real
that
quick,
my students
bro.
as a new trader should think about 20.
I
So
paused it. Go ahead.
are you understanding anything that he's talking about right now?
Kind of, but you can break it down for me more.
So essentially, just try to think about it like this, bro. The market is going to always seek to take out the people who's in profits, right? And I'll give you an example. Now, do you see that yellow the you see the second yellow box that he have, right, marked out?
Yes.
Now, do you see that horizontal line that he have on the swing high?
Yes. What about it though?
Right. So now look at the third yellow box, right? When the market went above that horizontal line, right? Or let me ask you like this. But even before the market went above that horizontal line, who was in profits? Sellers or buyers?
I would say sellers.
Why do you think sellers?
Because somebody gotta buy the stock from them.
The people who was in profit was buyers. Why? Because the market was going up.
Okay, so
Right? The market was going up.
you saying the people that was buying was actually the winners, and the people that was. But if I already got the stock and I'm about to sell it, I probably bought it for the low, right?
Exactly, right? So you bought. That's the key word. You bought it. So the buyers, right? So when the market was going up,
Okay, I
those were
get
the
what you're
people that
saying.
was in profit, right? Those are the people that was in profit. Now notice how when the price went above that horizontal line that I was just telling you about, that's marked out on that
Yeah.
second yellow box. Notice how the market quickly dropped down to take out the people who was in profit.
So then comes the question: if I'm investing with 1,000, I get a chance to buy low. How much should I put in? Go all in?
No. You're not even following the concept that I'm trying to teach you right now, bro. I'm trying to simply tell you to think about it like this. What he's trying to teach you right now is that the market is going to always look to take out the people who's in profit. So when the market was going up, the people who was in profit was the buyers, right?
The people who
Let
bought
me
low,
break this
right?
down for you one more time. Let me break let me break this down for you from the beginning, right? Look at the
All right, let's
second
break it
yellow
down.
box, right? Now, do you see in that second yellow box, you notice how the market started to come down a little bit, right?
Yeah, bitch, that bitch dropped, and then it went up and dropped again, went up and dropped again.
But just try to stay focused though. The market was coming down. So when the market was going down, who was in profit, bro?
When the market coming down, the buyers,
Yes.
because I'm buying it because it's low.
No, the sellers, bro. The sellers were in profit when the market was coming from that yellow box.
So you
The
gotta
sellers was
explain that
in
to me.
profit
How?
because
Yeah, I'm about to say you gotta explain how was they in profit.
bro, when you're short selling, you make money. Like when you're short selling, bro, you're betting on the market to go down. So that's
Oh,
where the profits come from, right?
okay.
When you're buying, you're betting on the market to go up. So that's where the profits come from. So look at that yellow box, right? When it was going down, who was in profit?
So when it went back up on the second yellow, I mean my bad, on the third yellow box, who was in profit then?
No, focus on the second yellow box, bro. When the market was going down, who was in profit?
The buyers, the sellers.
The sellers, bro. I literally just gave you the answer. The sellers was in profit, right? Because the market was going down, right? Do you see it? Are you able to keep up?
Yeah, I'm looking at it right now.
Right? So when the market was going down, sellers was in profit. Now, what did I just tell you? The market is going to always look to take out who's ever is in profits, right?
So what's the
Yes,
strategy
no, maybe so.
for profit?
You say what?
So how do you always make sure that you always don't lose your money and keep making money?
Well, that's a whole nother lesson. But
Okay.
for one, you have to not be greedy, and you have to have a target to where you know where to take profit at, right? But that's a whole nother lesson that we're going to get into in later videos. But essentially, I'm trying to teach you the concept that he's trying to teach you right now in this video, right? So just try to keep up with me. I'm asking you specific questions for a reason, bro. So when the market was going down from that second yellow box, sellers was in profit, right?
Yeah.
Now you notice how on that swing high that he put on that swing high from the yellow box, you notice how he put a horizontal line on top of that swing high, right?
Yeah.
And then what did you see
Second
the
yellow
market
box,
go
right?
do? And, yes, the second yellow box, right? Now, what did the market go do in the third yellow box, right? The market went back up to take those sellers out of the market. The people who got greedy, the people who wanted the market to go down even more, the people who have held on to those trades. I mean, I've been there myself. This is how I know that there's people that does this all the time, right? the market went back up above that horizontal line to take those traders out of their winning trade that they was once in, right? That's called ICT calls that sell stops, right? That's why he put that horizontal line right there,
Okay, yeah, that makes sense.
right? So in that third box, right? Notice how after they took out the sellers, now who do you think is in profit? Because the market was just going up, right? The market was just going up to take out the sellers. So obviously the buyers are now in profit, right? Remember what I just told you. The market is going to always look to take out whoever is in profit. So now because the market was going up and the buyers are in profit and they wanted to continue to go to the moon, what do you think is going to happen now? The market is going to come back down and take out those buyers, right? Because if they entered at those low prices that you see on the chart, and then the market went up, and some beginner traders' mind, they always want the market to just keep going forever and ever and ever. But that's not how the market works. The market always aims to take out whoever is in profit, bro. That's all I want you to at least. If you can't remember anything else right now, just at least try to remember that the market is going to always aim to take out whoever is in profit. I'm not going to be able to teach you everything in one video, bro. I don't expect you to become a master overnight, but just at
The
least try to
market is
remember
going to
that one
always
thing.
aim to take out whoever's in profit. I wrote it down. Yeah, I was over writing shit down, but
Yes.
so again, start with 1,000. All right, that's doable. All right, because I'm about to do this shit. That's what I'm asking. Let's keep going.
20 to 30 pips per week to start. And that's a very, very low threshold objective. It's easy to get. Probably doesn't feel that way now as a new trader, but I promise you, over a few lessons, you'll see how very easy it is to find 20 to 30 pips over the course of a week. The problem's going to be your ability to refrain from trading once you get it. In your demo account, you should exercise patience and not do any more. Wait till the next week, because this teaches two important and crucial elements to longevity in trading. Number one, it teaches patience. Patience, waiting for the next setup. Now, there's going to be a lot of gyrations in the chart that's going to draw your attention. You're going to want to do something with it. There's nothing wrong with paper trading it. In other words, making notations and saying, okay, I would hypothetically do this and hypothetically do that. But when you practice with a demo account, doing one execution, manage it to get 20 to 30 pips for the week, and then stop. Don't do any more demo trading. And it also teaches discipline. So you're forcing yourself to follow rules. Everyone else is taught in the books to trade your edge. Keep doing the same thing over again. While your hand's hot, play it hard. That's just foolish. We're not gambling. We're looking for high probability scenarios and setups. So we have to understand what that is. So in addition to, and a complement to the high probability scalping course, I'm using this first video to kind of like segue into a little bit more detail. I want you to think about what makes price move. Prices move to levels where orders reside. Now, orders reside above old highs and below old lows. So if we see double tops and double bottoms, our chart should be noted like this. Notice there is an absence of any kind of indicator except for now the application of a Fibonacci. The Fibonacci is what I taught to use to get the optimal trade entry. Now, what I'm going to show you here is the classic ICT optimal trade entry. 62 to 79% retracement level, get short, look for an objective going lower. And here, you can see how price did have several opportunities to get short at the 62% retracement level. And then finally expanded down, hit the first scaling objective, which is the old low, seen here. Then target 1 is hit, target 2 is hit, and then the symmetrical price swing. Okay. All of these levels are in agreement with running below these equal lows. So it's not the fact that the magic is done by the Fibonacci. The understanding is there's traders that have been going long here. Double bottom is going to have trailers on their buy positions, bringing their sell stops up. So the market's going to come back and grab those orders. The market does, in fact, collect all the sell stops and then look at the nice vault higher in price afterwards. This big response here is post sell stop raid. In other words, after the sell stops have been gathered up and tripped, anybody that was long now has been knocked out. So if they bought here or somewhere in this run up here, okay, they have been taken out. They can't capitalize on anything going higher. But what happens if you don't have...
All right, get down.
I just wanted to make sure you understood some of the technology. So when he says going long just means the people who is buying, right? And when he says going short, that just means the people who are selling the market looking for it to go down. Just wanted to make sure you understood some of that terminology so you're not getting too lost in the conversation.
I'm glad you put it down because I wasn't understanding everything. All right.
It's all right, bro. You're not going to really get all of this stuff in the first try.
No, I definitely. I didn't expect to. If nobody get nothing in the first try, that'd be stupid. But shout out to all 10 of y'all watching. Make sure we get at least 10 likes. At the very least, let's get 10 likes on the video because that's how the video get pushed out further into the algorithm. So we need at least 10 likes. Okay. Oh, and then also because we also reviewing ICT forex video, fair use.
Have the classic ICT optimal trade entry on your chart. So you miss it. What do? Well, if you don't get into that Fibonacci 62 to 79 chasing level as that bounce occurs here, what are you left to do? Do you just let the trade go? No. Over the years, I've shared examples of me getting into a trade, and for those individuals that aren't really interested in learning from me, they're quick to point and say, well, that's chasing price. And you see, just because we're not entering at the 62 to 79% trace level and we're getting in somewhere down in here, that's not chasing price. It's absolutely not chasing price. And I'll give you a perfect example of it in this recording. But I want you to think about what can we do as traders if we don't get this area up here, because I first taught that this is where you should get in at. The problem is over the years, I've been inundated with emails stating that folks don't have the courage to get in and they want to get in, but many times they are too afraid to chase price because they heard me preach, don't chase price, don't chase price. My definition of chasing price would be once it breaks below the low here, then you are chasing price. If it's gone too far and you're too close to where the targets would be to be able to see a profit. Okay, so what do? Well, we can focus in above that low in this area right in here. I'm going to take you right into that area with a little bit more detail.
So he's about to zoom into the chart, bro.
Price action.
He zoomed into the chart.
In.
Bet.
No, I wasn't telling you to zoom in. I was just saying that's what he was about to do so you don't get confused. He's just taking us into that small little section. Yeah, he's just taking us into that small little section that he was showing you, and he's zooming in on the lower time frame.
Oh, he did crazy. I mean, shit, it's a lot of information and video. Child.
And I want you to look at this. The up candle right in here prior to this down move, this is what I refer to as a bearish ICT order block. Now, every up close candle and every down close candle does not make a order block. Okay, there has to be a context or a storyline behind why the price should be doing what you anticipate it doing. In this case, we think that the sell stops below the marketplace are going to be rated. Anytime we see an up close candle, smart money will be in that candle selling short. But how can we use that information? Well, this very next candle, if you read the annotations on the chart here, price actually returns back to the bearish order block low. Okay, in other words, the low of this candle right here, price is returning back to it. Right at the time of this candle's close, it hits that low. At that time, that's a low risk entry. Despite trading lower initially, we can wait for price to retrade back to the order block to get in if we know what we're looking for. So this retrade back to the bearish order block is a low risk entry point. Now, if the short is valid, this up close candle will hold price below it until the targets are reached, or in this case, the sell stops that would be targeting below the equal lows. Now, notice also in here, as long as price is still above this low, this setup is staged properly to reach for the liquidity pool below those equal lows I noted a moment ago in the recording. Now, as long as it's above this low right here, the setup is still valid. But now I want you to think about this formation right here. This candle already starts moving lower. It went down to this point here and then started trading back up higher. At that moment, while you're watching price, right in here, that's when you time your entry. Notice that the candle's retracing right back to the ICT bearish order block's low. And that's this up close candle's low. That is exactly when your entry is made at the market. Institutional traders will short during up moves. Now, when price returns back to these up close candles, we can be shorting it as well. All right, so now back to our example here. If we see that we can find levels that have double tops and double bottoms, and the market will want to go through them. Once this occurs, chances are the market's going to go the opposite direction until it reaches another area of liquidity. So the market's always gyrating back and forth, seeking liquidity above the marketplace and below the marketplace.
So pause it, bro. Do you understand that
Below
part?
these equal lows, there's a specific.
No, break it down for me. What exactly does that mean?
That literally means exactly what I said earlier, right? When he said the market is always gyrating up and down, looking for liquidity. In layman's terms, that's essentially means what I just said. The market is going to always target those who are in profit. So in this example that he's about to give you, notice how when the market went below the double bottom, right, the little area he was pointing out, when the market went below that, it took out those guys who was in profits, right? Because that's where a lot of people put their stop losses. So the market took out those guys who was in profit. Now that they have taken out those guys, well, now what else is there to do, right? We got to find the other guys who's in profit. So now the market is going to find the group of people who's in profit, and they're going to target those people next. The more that you learn about like liquidity and the more that you learn about trading terminology, the more you will be able to understand some of the things that he's talking about.
No, yeah, I think the more I definitely get, like learned in the skill, the more I know exactly what you're talking about. Shout out to ICT. I definitely subscribe to his channel. I might cop one of his memberships. Let's keep going.
Now his membership free,
Range that I
bro.
look for.
Oh, it's free? Yeah, I'm about to slide on that bitch right now, then.
Yeah, and also, if you have any questions, bro, pause the video. Don't be scared to ask questions, bro.
Okay. Let's get it.
It's 10 to 20 pips. Sometimes it can be as much as 30 pips, but I give a working range of 10 to 20 pips. So there's only two levels I'm looking for. It's not a zone. Exactly 20 pips below that low at 118.84, it's 118.64. Okay, really simple. Specific price levels, not zones, not ambiguous areas to try to figure out what's going on. It's exact. It's a science. We know exactly what we're looking for. But the problem is, if we are expecting to sell short at that bearish order block at the low when it retrades back to it, does this offer potential for us to take a short? Well, we have an anticipated entry price at 118.91. we have an anticipated 20 pip sell stop raid price at 118.64. So in other words, we're anticipating getting in at 118.91 up here, which is the low of this up close candle. And we already know 20 pips below these lows, the lowest of the two equal lows is what I use. 20 pips below that, that gives us a range low of 118.64. So now we have 2 price points to determine whether there's enough of a range to make a profit. You take those two numbers and you minus them. 91 from 64 gives us 27 pips. So we have an anticipated range for profitable movement of 27 pips. That is enough to take a scalp. Now what I want you to do is I want you to watch me use everything that I just used here, because this is what was going on in my mind before I actually executed and why I took the trade. Okay, folks, we're going to be doing a short, and I'm waiting for it to trade right back to the bottom of this candle here. So if it trades to 118.91, I'll sell short. Not in a hurry. If it takes off without me, that's fine. But I'm trading the bearish order block in here. All right, folks, so I'll be looking for that price at 118.91. As soon as it hits it at market, I will go short. Now my stop has to be above the up close candle or bearish order block, but because of the spread in this demo account, it forces you to be 10 pips away. So I'm just going to elect to go with 119.15 for my stop. Okay, it's about there. My fingers on the trigger. All I have to do, boom. Okay, now I'm short. My stop is just below 119.15. And I'm focusing my attention right below these equal lows because I want to see a sell stop raid. So I'm going to put my delineations on where that would be in terms of targeting. And just in case, I have my limit order lowered down to here. Okay, so if it goes down to that low and it's not a stop run, I have a limit order to catch any accelerated price movement. But I'm really targeting that 20 pip run. So I have 3 lots short. I'm watching price. I want to see it trade below that short-term low that we're flirting with, and then have a range expansion below there. So this recording is actually sped up for time purposes. But right now we're retesting the bodies of the candles and the previous short-term low, and now I'm going to be looking for expansion on the downside. And it'll reach 10 pips and hopefully 20 pips. It's about 2 minutes away from 8:30 New York time. Usually that's a big volume increase for volatility. And I'm setting my order up to collapse 2 of the 3 standard lots that I'm short on euro. And I'm waiting to see if price gets down to that second level or 20 pips. Okay, it's already shown 10 pips of the decline. And as soon as it hits that lower level line, I'm going to collapse 2 of them. There you go. And move my stop down to +1. Now I'm in a situation where I don't really care. But look at the entry points. 0 heat. No drawdown on that entry. No drawdown whatsoever. It was not chasing price. So I have 2 of the 3 standard lots banked. And now I'm watching price later on. And I'm going to be looking to lower the stop loss. And I may get lucky here and see a run down to that limit order. But always keeping in mind that I started the trade with the context of it being just a stop run on sell stops. So I want to be mindful of how much the price shows a willingness to stall or not want to go lower. And I'm watching price in here to do that. So I've collected a small portion of the position also. Now here's the second time taking something off. So a very small portion of the original 3 standard lots on. Now it's a small little fragment of the position. Price does one more attempt to break lower. Again, now it's 10 o'clock, so time has passed. About an hour and a half has gone by. And at this time, I'm watching price. I do not want to see it reverse or start to show a sign of rejection. Stop has been lowered. to now I'm going to be trying to lock in 20 pips with my stop loss. As it breaks down, I will lower my stop, so that way if it does knock me out, now I have 20 pips locked in. 25 pips is locked in. Now we're in an area where it could start to reverse. It could fail to get down to that other limit order. So I'm not going to be able to move the stop because the spread won't permit me to do so. So I have to either allow my stop to be hit or my limit order to be taken, or I can collapse the trade. Now, I was away from the computer here at the time, but had I been there, I would have been collapsing right now. But ultimately, the price comes back up, and it does, in fact, stop me out eventually, as you'll see. But I profited along the way, taking out small portions, because you never know. You never know if it's going to go down to your objective, and if you've taken the risk on initially, that risk needs to be reduced to a point of which where it's no longer impactful. And there's my stop loss being tagged, and there is the fruits of short. Very, very predictable in terms of price action, and not a bad little scalp for a run on stops. The context was there, everything was outlined, and you can see the post-trade results. Ultimately, later on, you can see, as we showed in the beginning of the video, Eurodollar does vault up higher after running those stops. Hopefully you found this insightful. Until next time, I wish you good luck and good trading.
And that's the video, bro. So I'm interested to hear some of your thoughts. What were some of the key takeaways that you remember from the video?
I mean, mainly I remember the things that you said more than the things that he said.
And what are those things?
Is that the market is really going to play against the person that's profiting mostly, so you got to have a strategy to go against that, which is more what he was talking about.
Right. Did you understand the trade that he showed you? His little trade breakdown?
I understood how he was trying to break it down, but no, not completely. Break it down for me exactly what he meant, and for the audience.
Okay, so this is one of the things that ICT gets criticized on the most. You know, he used all of this quote unquote fancy terminology, and it confuses a lot of beginner traders, makes them not even want to learn. And I have experienced this with people that I have introduced to ICT, and they have always said the same thing, like, man, I don't understand what he's talking about, etc. Right? But essentially, what I want you to remember from that video, bro, is essentially this, right? When you first look at a chart, the two main things you want to immediately look at is swing lows and swing highs, which is essentially where the market peaked out at from the top or where the market peaked out at from the bottom, right? And those are some of the areas he had highlighted on the chart, or those were some of the areas he had his horizontal lines on his charts, right? And when you see the market go above or below those horizontal lines, you're then looking for a reversal, right? You're looking for the market to start going in the other direction. In the example where he showed you his trade, what he didn't talk about was the reason why he was able to trust that sell was because the market had already taken out that swing high, right? So typically when the market already takes out a swing high or a swing low, it has no reason to go back up there and take it out again. So, for example, the trade that he showed you, the market had just previously taken out a swing high. That's how ICT was able to understand that, okay, the swing high is taken out. What is the market going to target next? The market is going to target a swing low, and that was that horizontal line that he marked out on the chart, which was his profit taking area, right? You remember you asked me that question. You said, "How do I know where to get out at?" Right? So that horizontal line on his chart is where that's how you start learning where to get out at. And there's other things that you're going to learn as well, like fair value gaps, order blocks, and all type of other things that you can look at to get out of your trade as well.
Okay. Well, that's a good simplified way of explaining it too.
Yeah,
Because
yeah,
how he was using a lot of terms that maybe the audience is not really familiar with.
yeah. Some of the audience may be familiar with because a lot of people here probably already know about ICT, or they probably have been trading for at least 1 year or more. But I know, like, because you're a complete beginner, I know that you wouldn't understand a lot of those terms, and that's one of the main reasons why I wanted to be here with you to try to help break some of this stuff down to you, and kind of like just kind of like hold your hand through the whole process. Because a lot of this stuff is really simple, but when you're first learning it, it can feel a little bit complicated.
No, I definitely can.
So I hope you don't feel intimidated by the new information. I hope that you still have that excitement to still want to learn and come back and hang out with us over here, and we all can just learn together. Melissa said one thing that she learned was how to wait. What? Can you read that comment she just posted, bro?
It says one thing I learned was how assets getting into trades, how to assess getting into trades, how to assess getting
Oh,
into
okay,
trades.
okay, yep. Cause I know like I do a lot of this stuff with Melissa too. When we're at home, you know, I'm I try to get her to watch as many ICT videos as possible. Believe it or not, bro, about 90% of his content I have consumed it at least 2 to 3 times. Right? So I don't expect you to get all of this stuff on the first day, but we're going to continue to build you up as time go on.
All right, bet. That's all we need. So you help me with this, I'll help you with the content, and we build it. We build each other up.
Let's get it, bro. I definitely appreciate you for coming over here. Y'all make sure y'all leave a like on this video for my brother. You know what I'm saying? It's not easy to learn
We're
this stuff.
streaming
I'm
to
pretty
your
sure.
channel.
I mean, yeah. I mean, just leave. That's what I'm saying. Leave a like on the video. Support the channel, right? So support my brother in his journey and becoming a day trader or an investor, right? Because we don't really know what type of trader he's going to become, but what we do know is that he's going to eventually use these concepts, no matter what he's trading, no matter how he's trading. So just show some support, y'all. I appreciate everybody who stopped by to watch the channel. Um, you guys are the ghosts. You gals are the ghosts. I appreciate that. And we're going to see y'all in the next video. And leave a comment down below if y'all like this video. Some things that maybe we can do better. Give us some feedback, and we would greatly appreciate that. Is there anything you want to say before we get out of here, bro?
Oh, thanks for spending time in your day for even doing it. And we're gonna plan it on the next one and the next one. It's episode 1. Make sure you put that in the title. In YouTube, in your YouTube description, put season 1, episode 1.
All right, bet it up, man. Let's get it, y'all. I'll see y'all in the next video. Peace.
And make sure you guys share and leave a comment for the algorithm. Peace, guys.